Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Plug Power stock so we can determine if it's a buy or a sell. Plug Power is engaged in the development of hydrogen fuel cell systems that replace conventional batteries in equipment and vehicles powered by electricity. The company is headquartered in Latham, New York, and has facilities in Spokane, Washington, and Rochester, New York. Plug Power's GenDrive system integrates fuel cells manufactured by both Plug Power and Ballard Power Systems and incorporates a hydrogen storage system that allows the system to recharge in a matter of minutes, as opposed to several hours for lead-acid batteries. It allows hydrogen-powered forklifts to run at a constant steady power compared to conventional batteries, which experience droop in their output as the battery drains. GenDrive units occupy the same space designed for conventional batteries. The company was founded in 1997 as a joint venture between DTE Energy and Mechanical Technology Inc. The company went public in October 1999. The company was subject to a shareholder class action complaint for securities fraud following the IPO, for misleading statements about their fuel cell technology capabilities, and on its material sales and distribution relationships with GE. In December 2004, they settled the lawsuit and paid $5 million to the plaintiffs. In February 2017, the company announced the first shipments of its ProGen fuel cell engines designed for electric delivery vehicles and the adoption of its GenDrive system by the United States Postal Service forklift fleet in Capitol Heights, Maryland. In February 2020, the company introduced a 125 kilowatt ProGen fuel cell engine for Class 6, 7, and 8 trucks, and also for heavy-duty off-road equipment. In January 2021, SK Group, a major South Korean company, invested $1.5 billion in Plug Power for a 10% share. They will form a joint venture company in South Korea to supply hydrogen fuel cell products to Asian markets. In January 2021, the company signed a memorandum of understanding with French automobile manufacturer Renault. In March 2021, Plug Power filed a notification of late filing with the SEC stating it could not timely file its annual report for the period ending December 31st, 2020. Later that month, in March 2021, the company announced that they would have to restate financial statements for fiscal years 2018 and 2019, as well as some recent quarterly filings. Plug Power is subject to an ongoing shareholder class action lawsuit for securities fraud over alleged misrepresentations and failures to disclose its inability to timely file its 2020 annual report, and also material weaknesses in its internal controls over financial reporting. Let's get started with the model. This is a mid-cap company, 6.4 billion market cap. They're trading at $10.69 a share, and they have 599 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So it looks pretty terrible, their free cash flow. It goes from negative 200 million to negative 550 million to negative 1.3 billion to negative 1.5 billion. So they're bleeding cash. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year and getting worse. Revenue is a sales for the company, and it's kind of odd that they had negative revenue in 2020. I did look at their 10K, and this is accurate. They did grow their revenue to 800 million in the trailing 12 months. This is from their 10K, and it explains why they had negative revenue one year. The company had said that revenue and results were hurt by 456 million of costs in the quarter. The majority of those costs were charges related to the accelerated vesting of a customer's remaining warrants. The customer was not identified. The vesting of those warrants prompted the company to report revenue of negative 316 million for the quarter. So in one quarter, they had negative 316 million of revenue, but the 3 other quarters in the year, they had positive 216 million of revenue. So that's why they reported negative 100 million for the entire year. Warrants are long-dated options. Warrants are issued by the company. They're not like options which are traded on the open market. So a company may give an investor or an employee warrants, which gives them the right to buy the stock at a predetermined price sometime in the future. I don't understand why warrants would affect revenue. It seems like an operating item. It should be reflected on the income statement below gross profit. I do understand warrants investing and how it could detract from the company's profits, but I don't really understand why it's detracting from revenue. It should just be an expense item. But if it makes sense to you why it was taken out of revenue, let me know in the comments. Let's go through their first quarter earnings slides. Plug reports 210 million in revenue in the first quarter, up 49% year over year. They reaffirmed their 2023 targets, focusing on key initiatives to enable revenue growth and a path to profitability. Plug's Georgia liquid green hydrogen plant will complete commissioning and continue to ramp to liquid production throughout Q2. This plant has been brought online in less than a year, issuing the full EPC contract, engineering, procurement, and construction contract, marking a new industry standard for the construction timeline of a liquid hydrogen plant. Gaseous hydrogen production has continued at the Georgia plant. Their green hydrogen build-out is on track. Leveraging learnings from Georgia, we have been able to negotiate a lump sum turnkey construction contract for our Texas plant. And we have selected an EPC management company for New York. Electrolyzer sales opportunities expanding globally. Deliveries into our 2 gigawatt backlog in 2023 range across large-scale projects and 1 to 5 megawatt containerized solutions. Large-scale stationary offering creates substantial revenue growth opportunity. They continue to see strong demand from EV fleet owners given their grid constraints. Scaling new production facilities. Gigafactory on track to produce 100 megawatts of electrolyzer per month by mid-Q2. Their growth remains robust in France. Multiple non-dilutive financing opportunities available to support anticipated powerful growth and the build-out of our green hydrogen network. They're evaluating several financing options with counterparties, including the Department of Energy Loan Program, strategic project investment partners, and asset-backed loan facilities from major banks. Between their current cash position, $5.7 billion on the balance sheet, and interest from multiple capital partners, we believe Plug is well positioned to fund forecasted growth. Progress on 2023 objectives mark an inflection point for Plug. Plug's speed of execution in our first of its kind green hydrogen plants and commercialized fuel cell products remains unmatched. Our learnings from this journey continue to be invaluable as the company engages in multiple significant business activities, many of which are approaching inflection points, with an estimated 10 trillion addressable market by 2050, and multi-billion-dollar opportunities in the near term across our various product lines. Plug Energy, our vertically integrated hydrogen platform strategy, has established Plug as a one-stop shop for capital equipment to produce, liquefy, store, and transport hydrogen. Plug Fuel Cell Applications. We have a track record of innovation in developing industry-leading fuel cell applications for stationary power and mobility, drawing on our experience in material handling and manufacturing. Plug continues to expand our industry-leading manufacturing capabilities and supply chains to support exponential growth and cost-down roadmaps. Here's a visual of their infrastructure: the power source, the use of hydrogen, the dispense of hydrogen, the storage and handling of hydrogen, then the trucks to export it, and then the final step to produce and liquefy the hydrogen. Their 2023 roadmap: Gigafactory reaches full capacity of 100 megawatts per month of electrolyzer stacks. Georgia plant reaches 15 TPD of liquid hydrogen production. That stands for temperature programmed desorption. It's kind of a weird word, desorption. The TPD is used to determine the experimental conditions needed to characterize the dispersion of precious metals by hydrogen chemisorption on three-way exhaust gas catalysts. It is shown that hydrogen chemisorption on the samples is activated. Whatever that all means, that's the description. Their third item, project development and execution at Louisiana hydrogen plant. Commissioning and constructing an additional 150 to 170 TPD of hydrogen plants to reach 200 TPD target. Stationary power manufacturing line begins production at Vista facility and first commercial deliveries take place. That'll be a big win for this company when first commercial deliveries take place. 80 plus material handling sites and additional pedestal customers. Electrolyzer backlog growth with Plug winning large-scale project mandates globally. And the last item on the roadmap, continued sales momentum and backlog growth in liquefier and cryogenic businesses. Here's their hydrogen plant development strategy. They took control of the land in Georgia, Louisiana, New York, and Texas. They executed power purchase agreements in 3 of the 4 locations. They're in discussion in Louisiana. They did get permitting in each location and they started construction, so it looks like they're well on their way. And by the end of the year, they should be completed with commissioning in all their locations. And by the end of next year, they should be at full production at all locations. And they have a page for each location. In Georgia, Plug has made significant strides in ramping up liquid hydrogen production, with plans to begin production in the second quarter of 2023. In Louisiana, Plug and Olin announced the launch of a 50-50 joint venture to begin construction of a 15 TPD hydrogen plant in Louisiana. The site broke ground last quarter in the first quarter of 2023. Alabama, New York. That's a town between Rochester and Buffalo. I completed my undergrad at SUNY Buffalo, so I know a lot of the towns in upstate New York. We continue to make progress on our green hydrogen plant in New York to reach 75 TPD of capacity to start commissioning in Q4. In Texas, the 45 TPD plant in Texas broke ground in Q4 2022. All permits are in place and long lead time items are scheduled to be completed. Other projects. Plug is in the process of evaluating multiple sites for either new or expanded production for up to 45 TPD of liquid hydrogen production. Let's go through their most recent 10Q. This is as of 3/31/2023. Their common stock has a par value of 1 penny, ticker Plug. It trades on the NASDAQ. The first financial statement is the balance sheet. Their cash was $690 million at the end of 2022. It's currently $474 million. Restricted cash, $175 million. They also have $722 million of restricted cash in non-current assets. I'm always curious what a company uses their restricted cash for. To figure that out, just search that term, restricted cash, and you should find it in the document somewhere. So their restricted cash is in connection with certain sale and leaseback agreements. Cash of $445 million for these agreements, and $384 million was required to be restricted as of March 31st, 2023. So this means they needed to hold $445 million of restricted cash as of March 31st to collateralize the sale and leaseback agreements. Also, as of March 31st, the company had certain letters of credit backed by security deposits totaling $363 million. The $380 million is the restricted cash for December 31st. Also, the company had $75.5 million held in escrow related to the construction of certain hydrogen plants. They also had $5 million, $1.2 million, and $1.8 million held by their paying agent in connection with Applied Cryo, Joule, and CIS acquisitions. They have $1 billion of available for sale securities, and you could search this dollar amount, the $1 billion. This gives you a breakdown of what those securities are. $160 million of corporate bonds, $860 million of US Treasuries. So pretty safe investments, highly liquid. Available for sale means they can sell it at any time and get the cash. If it was held to maturity, that means they would have to wait till the security matures to get the cash. They have $139 million of equity securities. You could also search this dollar amount to find out what it is. The entire $139 million is mutual funds, $68 million fixed income mutual funds, $72 million exchange traded mutual funds. And this $135 million down here, that's their equity securities as of 12/31/2022. I'll show you 134,836, and it's right here, 134,836. They have 128 million of accounts receivable. So that means they sold products to a customer, but the customer didn't pay yet. So they're owed that amount of money. Loss of inventory, 775 million. Here's a breakdown of the 775 million. 550 million and 22 million of raw materials and supplies. 139 million of work in process. And 65 million of finished goods. So the finished goods are ready to be sold. They need to work on the other stuff before it's a finished product and they could sell it. They have 99 million of contract assets. They talk about it right here. Contract assets relate to contracts for which revenue is recognized on a straight line basis. However, billings escalate over the life of a contract. Contract assets also include amounts recognized as revenue in advance of billings to customers, which are dependent upon the satisfaction of another performance obligation. These amounts are included in contract assets on the unaudited interim condensed consolidated balance sheets. And you can see they also have contract liabilities on their balance sheet. We'll get to that later in the liability section. They have 250 million of goodwill. Goodwill comes about when you acquire another company for more than they're worth. This section talks about intangible assets and goodwill. Their intangible assets are acquired technology, dry stack electrolyzer technology, and customer relationships. I'm not sure what the goodwill is for, which companies it's tied to. They just show us the goodwill as of 12/31/2022, then a foreign currency adjustment, and then the goodwill as of 3/31/2023. So it looks like some of the companies they acquired were not US companies. That's why they have to do a foreign currency translation. Maybe on their 10K they list the companies that make up the goodwill, but not in their 10Q. They have 156 million of prepaid expenses. A prepaid expense is when a company makes an advance payment for a product or service they're going to receive in the future. So they have 3 billion of current assets, 700 million of current liabilities. So their current ratio is a 4. They can cover their current liabilities 4 times with their current assets. Let's look at their non-current assets. 700 million restricted cash, 874 million of PP&E. Let's see if we can figure out what the PP&E is. 1.8 million of land, 700 million of construction in progress, 40 million of building and leasehold improvements, 188 million of software, machinery, and equipment. The gross value is 928 million. They depreciated 54 million, so the book value or the carrying value on the balance sheet is 875 million, which is up from last year of 720 million. It gives a little more info down here. Construction in progress is mainly the construction of 5 hydrogen production lines, the Gigafactory in Rochester, and a facility in Slingerlands. They have 57 million of right-of-use assets. These are finance leases, and 370 million of operating leases right-of-use assets. These are assets that are owned by another company that they're leasing or financing. So they put it onto their balance sheet as if they own it. But since they lease the assets, you also see how much they owe on the lease. That's in the liability section. Operating lease liabilities, 270 million. Finance lease liabilities, 39 million. Equipment related to PPAs and fuel delivered to customers, 98 million. 25 million of contract assets, 249 million of goodwill. 200 million of intangible assets, and 67 million of investments in non-consolidated entities and non-marketable securities. This means they're invested in private companies. Their total assets are 5.7 billion. In their current liabilities, what they owe within the next 12 months, 188 million of accounts payable. This is when they bought products on credit, so they owe those businesses $188 million over the next 12 months. Accrued expenses, 167 million. These are expenses a company has incurred but hasn't paid yet. Here's a breakdown of the 168 million. Accrued payroll and compensation, 20 million. CapEx, 31 million. Accounts payable, 93 million. Sales and other taxes, 9.7 million. Interest, 2.3 million, and other 11 million. Deferred revenue of 137 million. Deferred revenue means they received payment for a product or service they're going to deliver in the future. Then we have operating lease liabilities, finance lease liabilities, 63 million of finance obligations. That might be a credit facility. 5 million on the current portion of long-term debt. 54 million of contingent consideration, loss accrual for service contracts, and other. In the non-current liabilities, how much they owe beyond 1 year. 83 million of deferred revenue, Then you have operating leases, finance obligations, convertible senior notes, $194 million. They issued $197 million of convertible senior notes, paying an interest rate of 3.75%. So they have to pay the interest to the note holder. The person who owns the notes can convert the debt to equity, which is what this company wants, so they get it removed off their balance sheet. The reason they may not is if the stock price doesn't go up. If it keeps going down, they're not going to convert. So if it keeps going down, then this company will have to buy back that debt. They'll have to give back that principal amount. And there's $3 million of costs and expenses when they issue that debt. They have to pay underwriting fees, legal fees, and those costs get amortized over the life of the debt. They only have $4 million of long-term debt and $180 million of contingent considerations. They have a $41 million contingent consideration with Joule. Contingent consideration is debt. Plug Power may have to pay Joule $42 million if a certain event occurs in the future. Let's look at the equity section. Equity is assets minus liabilities, and they have $3.9 billion of equity. They raised $7.4 billion from selling stock. They lost $3.3 billion from running their business, and they bought back $99 million of common stock. Let's look at their income statement. This is the first quarter of 2023 versus the first quarter of 2022. Revenue is up from $140 million to $210 million. Most of their revenue is from the sale of equipment, $180 million. $9 million of services performed on fuel systems, $8 million of power purchase agreements, $10 million of fuel delivered to customers and related equipment, and $1 million of other. Here's a different breakdown of their revenue. The sale of fuel cell systems, $29 million, which is down from last year of $37 million. Sales of hydrogen infrastructure, $48 million, that's up from $27 million. Sales of electrolyzers, $40 million, that's up a lot from $4 million. Sales of engineered equipment, $8 million, that's down from $22 million. $9 million of services performed, PPAs, $8 million. Fuel delivered to customers, $10 million, down from $13 million. Sales of cryogenic equipment up a lot from $18 million to $56 million. Of the $210 million of revenue, $160 million in North America, $40 million in Europe, $3 million in Asia, $5 million in other. It does look like they're expanding because they had no revenue in Europe and Asia last year. But revenue in other is down from $27 million to $5 million. I'm not too sure what countries make up other. Let's look at their cost of revenue. To generate the $180 million of revenue, it cost them $158 million. To generate the $9 million of services, it cost them $12 million. That's a loss leader. They lost a lot on PPAs. That cost them $46 million. Fuel delivered to customers cost them $54 million. Revenue of $10 million. So their cost of revenue is higher than their revenue. So they have a gross loss of $69 million. Last year was a loss of $35 million. And then they have operating expenses, R&D, $26 million. You can search the words research and development to figure out what it is. This includes materials to build, develop, and prototype units, cash and non-cash stock-based compensation, and benefits for the engineering and related staff. Expenses for contract engineers, fees paid to consultants for services provided, materials and supplies consumed, facility-related costs such as computer and network services, and other general overhead costs associated with our research and development. Selling, general, and admin expense, $104 million. And this includes stock-based compensation, benefits, amortization of intangible assets, and related costs in support of our general corporate functions, including general management, finance and accounting, human resources, selling and marketing, IT and legal services. So it's the payroll for those departments. Impairment of long-lived assets, $1 million. Change in fair value of contingent consideration, $8.7 million. So operating expenses, $140 million. That gives them an operating loss of $210 million. They receive $17 million of interest income. This is interest on their investments. They pay $10.7 million of interest on their debt. Other expense, $4.7 million. So their net loss is $207 million. Last year was $156 million. So that gives them a loss per share of 35 cents. Last year was a loss per share of 27 cents. And they added 12 million shares. They had 577 million last year. Now they have 589 million. Let's look at their statement of cash flows. In their operating cash flow section, they lost 277 million of cash. So even though they reported a net loss of 207 million, they lost actually more cash. Because the way you calculate operating cash flow, you start with your net loss, then you have to add back the non-cash items on the income statement. You have to add back things like stock-based compensation, depreciation, and amortization. Then you have to adjust for changes in working capital. They had a negative $129 million in inventory. So that means they bought $129 million of inventory in this quarter. But if they use the inventory, they sell it, then it'll be a cash inflow in that accounting period. They had a cash inflow of $96 million in their vesting section. They purchased $168 million of PP&E, property, plant, and equipment, and they sold $315 million of securities. These are the corporate bonds and treasury notes we saw earlier. And in their financing section, they had a cash inflow of $7 million. They received $28 million of proceeds from a financing obligation, and they paid $16.5 million on a finance lease. Let's see how they describe their nature of operations. Plug Power is facilitating the paradigm shift to an increasingly electrified world by innovating cutting-edge hydrogen and fuel cell solutions. We continue to develop commercially viable hydrogen and fuel cell product solutions. We have expanded our offerings to support a variety of commercial operations that can be powered with green hydrogen. We provide electrolyzers that allow customers such as refineries, producers of chemicals, steel, fertilizer, and commercial refueling stations to generate hydrogen on site. We are focusing our efforts on industrial mobility applications, including electric forklifts and electric industrial vehicles, at multi-shift, high-volume manufacturing and high-throughput distribution sites, where we believe our products and services provide a unique combination of productivity, flexibility, and environmental benefits. Here's their acquisition section: Alloy Custom Products LLC and Westmore Cryogenics. On December 5th, 2022, the company acquired two subsidiaries of Cryogenic Industrial Solutions LLC, Alloy Custom Products LLC, and Westmore Cryogenics LLC, collectively CIS. The CIS acquisition is expected to increase the company's production capabilities for stainless steel and aluminum cryogenic transport truck-mounted cryogenic pressure vessels, cryogenic transport trailers, and other mobile storage containers. They paid $30.7 million of cash to CIS, another $500,000 is due, and they gave them $6.1 million of common stock, so they paid $37.3 million. And this is what they received from those three companies: $5 million of accounts receivables, $11 million of inventory, $4 million of PP&E, $13 million of intangibles, total net assets of $24 million. So that means goodwill is $13 million, since they paid $37 million and the net assets are $24 million. The difference is goodwill. It's mentioned right here on the next page. They paid $37 million, net assets of $24 million, goodwill of $13 million. They also acquired Joule Processing. Joule is an engineered modular equipment, process design, and procurement company founded in 2009. They paid $28 million in cash and $42 million of contingent considerations. Remember, we talked about this earlier. They paid $70 million. They received $57 million of assets. Most of that is intangibles. So they have $12.8 million of goodwill from this acquisition. Here's a breakdown of their long-term debt of $11 million. $5.7 million is due this year, $3.3 million next year, $1.2 million in 2025, and $900,000 in 2026. So they don't have too much debt. The interest rate on the debt ranges from 2.2% up to 8.3%. In August of last year, they issued 16 million shares of warrants, and it looks like they provided these warrants to Amazon. Here's more info on a warrant agreement. Plug Power and Amazon entered into a transaction agreement under which the company issued Amazon.com 16 million shares of the company's stock, subject to certain vesting events described below. Plug Power and Amazon entered into agreement for Amazon to purchase hydrogen fuel from the company through August 2029. So that's a really big deal for this company. 1 million of Amazon warrant shares vested immediately. 15 million of Amazon warrant shares will vest over a 7-year term. The exercise price for 9 million of the warrants is $22.98. If the stock stays below $22.98, the warrants will expire worthless. They entered into another agreement with Amazon in 2017. 55 million warrants. That's a lot of warrants. And this contract is dependent on the deployment of this company's Gen Key fuel cell technology at Amazon distribution centers. 28 million shares were exercised in the first quarter of 2023, 24.7 million shares at the end of 2022. They also gave 56 million warrants to Walmart. The more warrants the company issues, the more it dilutes the shareholders. I'm sure you knew that. The company issued 220,000 shares of common stock and 96,000 shares of common stock pursuant to the Plug Power 401k savings and retirement plan. That's another way to reward their employees, probably mostly their executives, is to give them stock. In the MDA section, the company tells you the risks of investing with them. Number one is the risk that we continue to incur losses and might never achieve or maintain profitability. The risk that we need to raise additional capital to fund our operations. The risk of global economic uncertainty. The risk we may not be able to expand our business or manage our future growth effectively. And the list goes on and on. Lots of risks. Let's go back to my Excel file. This is their capital structure. 3.9 billion of equity, 900 million of debt. They're 81% equity, 19% debt. And they could pay off all the debt with the cash on their balance sheet and still have 721 million of cash left over. I gave them a WACC of 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 8.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.6 billion. We divide that by 599 million shares. And we get a calculated stock price of $9.42. They're trading at $10.69, so they're trading at a 14% premium. It's a sell according to the model. It is hard to value a company that hasn't had positive free cash flow, so I assumed it would be positive by 2025. And the way I calculated their future free cash flows, the company does provide revenue targets. Based off of those revenue targets, you can figure out what their future free cash flow should be. Simply, Wall Street values the company at $434. They say they're 146% overvalued. And there are 28 analysts that price this stock, and the average price target is $19. They say the stock is 76% undervalued. This is where the stock has been trading the last 5 years. Back in 2018, the stock was trading at $2. And then it hit almost $70 in the beginning of 2021. It's come down a lot since then. Imagine buying it up here. That would be really depressing because I don't think it's ever going to get back up there again. They have a pretty high beta, 1.75, so the stock is volatile. It's down 25% in the past 52 weeks, while the S&P 500 is up 19%. The 52-week low is 739, the high is 32. And it's a pretty popular stock. 30 million shares are traded on average the past 10 days. Of the 600 million shares outstanding, 540 million are on float. 57% are held by institutions. And it has a really high short percentage. Over 20% of the shares on float are shorted. There are 48 companies in the same industry as Plug, and if Plug has a number in red, they're worse than the median. If they have a number in blue, they're better. It looks like they spend the most in CapEx of all the companies, 559 million. They don't have much debt. For every dollar of equity, they only have 20 cents of debt. They're losing the most cash out of any company on this list. They rank 5th in market cap. The average is 2.7 billion. They're at 6.4 billion. And they have a really good price to book. Price to book is stock price over book value per share. And we can't look at their PE since they have negative equity. And we can't look at their price to free cash flow since they have negative free cash flow. And they don't have that good of a price to sales, 8.3. So that means investors are paying $8.30 for $1 revenue. Look how much revenue the companies below them generate. 3.8 billion, 4 billion, 3.7 billion. So they're really not generating much revenue for the size of the company. Their 5-year annual revenue growth rate is really high at 47%. So they are growing their revenue, but it's still pretty small. So to summarize, I have them trading at a 14% premium. They've been around 26 years. And they are a really interesting company. They could have a great future. It is hard to tell at this point. I totally get the excitement if you own the stock. They have some really exciting things on the horizon. I rank their free cash flows 1 out of 10, their revenue 6 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.